Welcome back. This is part 2 of the lecture recording for
Welcome everyone back to your commercial banking class.
This is a recorded lecture high-level focus on the Tuesday night
factors
section
that go into
determining
someone's
FICO
Week
score, which is
12.
one of the kinds of credit.
Continuing with
commercial
the
banking.
overview on credit policy.
Start as usual
Tonight
tonight with some housekeeping items.
Firstly, wanted to see
A bank's generally going to have a
talk about
way
ways
to
to
make
improve
up
your
completed
credit scores.
graded
I
exams.
encourage you to take a look at the
And
other
they're going to
slides.
outline the goals for a bank's portfolio. It's going to give certain
will have
limitations. It's
details
also going
here.
to outline what authority a loan officer has at a local level,
finance
maybe
office,
at a regional level throughout the day.
this week, so
And they'll stay there all of this week.
It's going to outline the process, and so needed in terms of elevating your additional levels of approval.
But
It's going to outline procedures and
pick them up
all
there.
kinds of
If you
detail,
have any questions,
as well as
or
what
concerns about
also
those,
needed. Okay, so
you'll
you'll remember we talked a little bit already that most large banks are going to have dedicated credit
you can look at this both from a banking standpoint, and historically those folks have sometimes been perceived as being adverse to the loan officer.
So I would encourage you in an overly simple way. Loan officers are out
overall
building business and trying to get an opportunity.
If you haven't made loans, check your credit report and credit policy.
Again, obviously I'm not asking for historically trying to protect the bank from little bad.
But what I'd like you to
certainly all banks are trying to have
that
that be a
comment on
collaborative
some of your findings
maybe
from
been
the
process,
and
you can simply do that by googling free credit report.
Now,
and you
in
can
a local community bank, a smaller bank setting, there may not be a separate credit person.
It may be all the loan officers together forming a committee or some group of the loan officers.
But we'll move on.
Let me move on material fairly quick. So say I'm a loan officer, relationship manager. I've worked hard to build a relationship with a business owner who say wants to
big
borrow
picture
money.
Now, we've talked about in less detail, but
I put together sort of
process,
my analysis of the deal. I bring it to either my credit approval or to the initial loan consideration to make the case for why we should do the loan, and then either that person or committee decides whether we will or will not do the loan.
And that whole process
Banks need to figure out those sort of
what
lending
price they
policies.
charge for.
We'll do a brief overview today, and then also in addition to the things I've already described, you might say,
we could outline
plus modeling is quite
any of the things listed here.
So we'll have a credit officer. Again, this is really
what are the rules
we're going to follow
for
for business lending.
We don't just
For those of you attending our operating costs here from Jim Connors, you'll get them also a business owner. What percentage of
this is a video I recommend that you watch.
Career. So you'll
demonstrate,
we talk about some of the practitioners that we have as banks and what kind of lending that we can do, and this is what kind of profit margin description of what if you compare those things. I will just say that the book, in my view, does a pretty good job on this topic. And so, moving on, as I've said, I encourage you to pause the video here and watch the video I just mentioned. It's not work, but assuming you've done that, moving on now. So I'm supplementing. This is really a core element in the statistics and pieces of information. Something you'd certainly want to commit to memory and learn.
You'll see on personal loans,
fees of lending dates are paid,
character
capacity, cash,
from a big picture overview
standpoint.
You just take a snapshot.
And this is a very important area at large. I think we'll start there. As I said, this week we'll also talk about consumer or personal labor. At that time, you can see it being for those you're evaluating as borrowers, whether they be businesses or individuals or families.
My hope is that
these are all
get a feeling for how banks make decisions on whether or not it's part of why I list this older data, because as we've really changed again, getting that right is probably the most important thing in banking.
Banks will look at risk in a lot of different ways. This is one example of how a bank can look at it as a safety zone for getting the funds alone, be competitive in banking. So first you're going to look at, we're going to get a little bit into the procedure around both personal and business.
There are very specific
payments
requirements
for how the rate
can
is to be calculated. You see that outlined in how that
assets or collateral that are illicitly needed. But
how my
homework
payments
assignment
try to be
operational
for your business community.
Well, we can go out and take ownership over, say,
credit
building report. And then finally, there's the personal guarantee.
Again, we'll ask you to submit again from a types of
so
loans.
then I want you
with that
layers,
context to go out and begin to apply. This is just stating the obvious, really. But
what does a typical loan agreement look like?
Even if you wanted to do a car
and when you get into
at a basic level, and figure out what kind of information do they want you to provide. Some of those are broken. What else did you notice in that process?
But there's the note itself. There's the loan commitment agreement that's going to outline
go out and check out your credit report about farm and what's to apply for a loan.
There's going to be any collateral
relate to commercial loans. But if you just step through that process, would be a piece of real estate without taking it to an operational, be able to have the learning experience. Big picture, how many loans are out there? So business and commercial lending again we'll cover next week in week 13.
In order for this loan,
so you've had an overview of
you must do the following things. And so
lending, credit policy.
Those might be simple things like provide us regular reporting and financials, or they may be things like keep your profitability over X
homework I described
or any number of signs. But those would be the two most common. Provide regular reporting and financials and maintain a profitability level of a certain amount.
Even with may also include again personal guarantees or pledges or warranties. There are 12 zeros. So
it's also
large
going to
outline
what happens if things do go bad.
Many times, and it's also going to outline the process by which you'll review
access
the
to
capital is an important part of our. Maybe you lock in a term or a rate for 5 years.
Of what
certainly you're not going to just
do.
Leave it out there for 5 years. So again, at this stage in the semester, we're thinking a little bit less about how to manage a bank and a little more about a specific task or role that might go on in a bank.
So things may be going poorly if you're not getting the documents you need, or you see the numbers changing.
Next is about how you do that
in any number of ways, which are outlined here. Going on here, the percentage of loans, really, loans as a percentage is what regular conversation of a bank, as we've talked about before. Larger banks tend to maybe take more.
And if things do go poorly, you're not just going to call on the loan and call it quits. You're very likely going to work with them to find a way to help keep the business healthy, or to repair it so they're able to make the loans, or if it's a person. So you want to be aware of it as quickly as possible.
Again, you'll see some variation.
And then you want to figure out how best to address it. And that may include changing
interesting point to make here is this isn't necessarily representing what loans were sold by a bank.
What I'd like you to do now, is whether as a group or presumably individually,
you may see a lot of banks, especially community banks,
take some time and look over your bank or both of your banks and take a look at the mix of loans.
And
how does it compare to the peer group
to another bank?
So why do you think they might have that mix?
For example, 100 million to
what
billion
observations can you make about their credit culture? So
have
if the mix of their loans is significantly more aggressively weighted towards, say, real estate loans than other kinds, or towards ag or other kinds, how would you explain that? Does that jive with what you've learned so far about
probably the individual loans?
What other observations do you have? So I'd encourage you to pause the video now, go out to the FDIC page, take a look at your data again relative to your peer group.
So
taking a look at
expect from me on an exam.
Net worth statement.
The largest single category of loans issued by banks are real estate loans.
Dig down into some closer detail
are
on the
a big
loans
part of that for
again, I encourage you to pause here.
Reasons. What would determine
the mix of
high level on
loans that a given bank may have?
And we will touch on this a little more next week.
Certainly, the risk profile.
Consumer lending, again, are loans to people, and there are a lot of laws and regulations really
that are oriented around making sure that banks treat everyone fairly and equally.
A small bank and a farm
and certainly banks have not always done that. Again, a bank is motivated by managing risk.
A large,
just like any other
business bank,
people, there are prejudices and things, unfortunately, that happen.
But there are other niches or
kind of equal
elements
to
a particular market that might drive.
And so there are a lot of examples of this, and each of these
have on
pieces
their
of
books,
legislation
what kind of mix of
loans they may sell, even if they don't keep them on their books.
Iowa City area is a good example of this.
The banks in Johnson County
and do a deep dive.
A whole lot of mortgage lending because there are a lot.
This gives you a little bit of a comparison for what
percentage of loans or what amount of loans are made to individuals as opposed to businesses. And again, you can see individual loans have grown in the last 3 to 5 years.
What do we mean when we say retail versus
wholesale? At times been more important than business loans.
There's been, I'd say, a big move to a more retail-oriented.
So when we say personal loans or retail loans or consumer loans, what do we mean? More and more of we basically mean mortgage loans, towards having more loans, non-residential kept on your own books, which is kind of a catch-all, as opposed to credit cards funds that you purchase from elsewhere.
And under that catch-all, you could have automobile loans.
Really, that's about managing risk and retaining as much profitability as you can.
Again, same sort of categories.
Of course, a balance.
And you're going to have the same sort of process as you would for a business loan, or just generally
do a lot of loans in a bank.
One of the things that's a little unique to personal lending relative to commercial lending
back on,
is that you have this credit score process, and so there's an entirely different.
So we need to balance not only good loans for the right price,
and we'll touch on a little bit,
in other words, risk and return.
As I move forward to the next slide, let me just mention that each bank, in addition to
that we've talked about,
sort of the credit score specifically that they'll get, they're going to give different weights.
Loans are also highly regulated, which
this is just an example of,
but you
what kind of scoring might be placed around
talked about loan limits,
different
that's a reality
of a person's life. What kind of work
really every bank, but especially smaller community
where do you live? Do you live in a house?
There are also requirements out there, some of which
how long have you been there? Do you have kids? What kind of accounts do you have? Those kinds of things all can be relevant on the personal front.
If not limit, direct the kinds
you see
of
some data here on FICO scores and personal
what
scoring.
Kinds of things they need to do really to have the right to
encourage you
serve
to take
a
a look
lending
at.
function in a community. Ultimately, all these things result in a rating that a bank's going to get. You see this outlined in the text in good detail. But the better your ratings are, the less frequently you're going to get checked in on. And so these are some of the elements of the rating that a bank's going to get. And I described, I think, in an earlier week, the importance of high ratings, and that 1s and 2s are pretty customary. When you start to get into 3s, or certainly 4s, you've got a problem on your hands. So, and again, this is something that was outlined in pretty good detail in the book, and so I won't bemoan the details except to say that, this is outlining the sort of the risk profile of the bank based on their lending procedures, and this gives some nitty-gritty on how banks should approach that. So when you look at where banks are having trouble, what kinds of loans are not working out, these are some categories to consider. So criticized loans, or loans in critical condition, are ones that you might say, we want to keep a special eye on, but where there's no known issue. In other words, they're not missing payments, but we want to be aware of it. Maybe the borrower is not in as good a condition as they once were, that sort of a thing. Scheduled loans means it's either the case that they have missed payments perhaps, or there's more significant reason to think that the loan may be in danger, okay? Or that the way the bank is lending around a certain area may be dangerous, as I write there. Adverse classification, when you see substandard, doubtful, loss, those are categories where there's an expectation there's going to be a loss on the loan. Okay, so loss, of course, being the strongest, that means it's a done deal. We're not going to be able to collect on the loan. Doubtful meaning that it seems very probable, and substandard again meaning it's likely. And so banks will start to account for those, as we've talked about, not only in making provisions to, based on estimates on what percentage of loans over time may not be paid back, but now starting to make accounting payments, if you will, to account for the loans we don't expect to get paid back. So you see some weighted averages here on how a bank may calculate those things. And as you look at your bank, this is an opportunity to review now the loan loss reserves and where the bank may be from a capitalization standpoint. Again, you can't have a whole lot of loans go wrong without having pretty significant problems from a liquidity standpoint for most banks. So actual no pays, I talked to you before about 2% being a sort of a rule of thumb in terms of percentage of loans that you might expect not to get paid back. Obviously that varies widely based on the kind of loan, and also based on the credit profile of the borrower, and those things are segmented. But 2%, sort of a rule of thumb. You see this skyrocket during the financial crisis all the way above 8% of loans that at least were non-current in some way. In other words, a payment was missed. So that's extremely high. When you think about the fact that most banks have around a 10% liquidity, That's a big portion of that liquidity that's being eaten up, and certainly the provisions for loan losses would not have accounted for that in a planning sense. Same kind of data based on the bank size. So larger banks are more aggressive, and they have a larger percentage of their banks or their customers not paying them back on the whole, you can see here. So let me pause there. We're going to break up the recording, and we'll come back and do a part 2 here.